from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Netflix hits a wall. The streaming giant loses subscribers for the first time in a decade, 200,000 of them, and says 2 million more will go. We've got the latest earnings report covered from all angles. Plus, after airlines, now Uber and Lyft are also dropping masks in the United States after a judge overturned a federal mandate for passengers to cover their faces. We'll talk about how that might impact ride-hailing's bottom line. And Bitcoin can't seem to break out of that $40,000 range, so can it really be a hedge against inflation? We'll speak with Michael Saylor of MicroStrategy, the world's biggest corporate holder of Bitcoin, about all this and much more. We'll get to that in a moment, but first, it is a bloodbath for Netflix with a drop in subscribers and a plunge in shares. Bloomberg's Ed Ludlow has been pouring through the numbers here. And Ed, this was kind of unexpected.
Yeah, I mean, hugely unexpected. 200,000 customers lost in that first quarter. The estimate by Netflix itself was to add more than 2 million. The street looking for that as well. The worrying part is the outlook for the second quarter. Another loss of customers, 2 million lost. The outlook was a gain of 2.4 million. That's the Wall Street consensus estimate. And in 3 out of the 4 regions where Netflix operates, they lost customers. The only exception to that rule, Asia Pacific. You see what the market thinks about it. We're down 25% in after hours. This is actually the 5th quarter in a row, though, where there's been a negative reaction to Netflix earnings. So, none of this we saw coming, but this is a pretty profound impact, especially when you consider the markets throughout the day. On Tuesday, we saw a rally across equities, outperformance in the technology sector relative to the broader market. And that's despite yields continue to be elevated. You look at US 10-year yield up 2.94 percentage points, also a risk on mode with Bitcoin getting caught up in it. The other big story, of course, that I've been tracking, Twitter and Elon Musk's bid to buy the company. Twitter lower on Tuesday. Really, the big news was Apollo getting in on the act, saying it would partner with Musk's bid, or according to sources, they would partner with Musk's bids, or another private equity firm in the form of a credit backing or preferential equity, something of that form. And then the New York Post reporting earlier Tuesday that Musk is struggling to get backers, but he could put $10 to $15 billion of his own money in and even do some kind of leveraged buyout, borrowing against the holdings of his Twitter stake. One story, though, we've got to focus on Netflix, because it's not just Netflix that's moving in after hours. You look across the streaming space and some of Netflix's peers, we're seeing serious declines. Disney down 5%. Paramount now little change in after hours, but Roku also suffering. Question is this isolated and just Netflix, or is the big growth we saw in streaming throughout the pandemic, is that over?
All right, and we're going to see that in earnings reports to come over the next few weeks. Ed Ludlow, thank you. I want to stick with Netflix and bring in Andre Swanston, longtime entrepreneur and executive in the streaming business, now an SVP at TransUnion. Andre, great to have you back with us. Look, first subscriber loss in a decade. What went wrong?
Look, I don't think it was unexpected to a lot of executives across the media and entertainment industry that Netflix was going to have challenges. I've been saying so for the last 18 months. To have such a large miss, I think, is a bit surprising. But there's a few core challenges that I think it's astonishing to me that Netflix hasn't adjusted, and even in the report don't seem like they're really looking to. I think the first one is there's a lot of talk about the competition from Disney and HBO Max and Amazon and others. And I do think that has some impact, right? But what people really aren't talking about is that most of the growth over the last 2 years in streaming has really been free ad-supported solutions. The Pluto TVs, the Tubies, the Zumos. And what the major media companies have done a really good job is they went and acquired all of those companies. And so while they made acquisitions to diversify their business model in streaming, Netflix is still yet to launch any sort of cheaper ad-supported or free ad-supported tier. So I think that was one of the main things. So inflation hurt them more, competition hurt them more than I think it'll hurt a lot of their competitors.
Part of this overall number we're seeing is Russia, and of course we saw Netflix cutting off service there. I believe it's only about 300,000 accounts total, but there's clearly a longer-term problem here with 2 million paid subscribers potentially going in the coming quarter. I mean, why are we seeing not just losses, but such deep losses?
Well, so, partly because there's nothing that they've done or mentioned that they're doing to solve these challenges. So the two things they talk to is about they're increasing the money and the investment that they're making into content. You can't really spend your way out of this because there's other huge companies that are going and spending billions and billions of dollars as well. So that's not really the challenge. The other thing that Netflix was really good at historically is they probably had a 6 or 7 year head start on when it came to data in terms of streaming media consumption for television and movie shows. And so what that allowed them to do is in essence, play Moneyball with content licensing. Now they can't do that because the owners of those content can monetize it themselves. They mentioned, launching the 2 thumbs up button to give them more insight. There's nothing that Netflix can do to gain more data and insight off of their platform that can help them compete with the diversity of the data that a company like Amazon has. They know what you buy,
right,
or Google knows what you search, and Apple knows what music you listen to as well. And so I think that's going to be a real challenge for them. And also the investments that they've made into gaming, they've spent tens of millions of dollars here, hundreds of millions of dollars. The people that they're trying to catch are spending billions of dollars on gaming and going into the metaverse. And so, I think just doubling down and tripling down on what they have been doing really well over the last decade and thinking that it's going to carry them through the 2020s is going to be difficult.
Our Lucas Shaw, who covers the entertainment business and Netflix for us, said there's a hard solution to Netflix's problem. He's not talking about ads. He simply says, make better shows. What about that?
No, I think that's actually the mentality that they pretty much have already doubled down on. If we can poach the biggest producers in the industry, if we can have the greatest TV shows and great movies, we can fend off companies like Disney that have 100 years of content that they can just keep updating. I think that strategy has already proven that it doesn't work, or else they wouldn't have had the miss that they did this past quarter.
So quickly then, how contagious do you think this is going to be? How much are we going to see this also reflected in Disney results, given, yes, a different library, but still they're also relying on new content?
Yeah, so I don't think the results will be the same in terms of other companies for a couple of reasons. One, the other streaming solutions are still new. They're still launching in new markets for the first time. So there's still potential subscribers that never had the ability to access their content. Whereas Netflix has had pretty widespread distribution for quite some time. So that's one thing. The second thing is everybody else has just about has a diversified subscriber model where there are cheaper tiers like Hulu or other things where subscribers can get in and pay less to see ads, or in fact, just completely free tiers. And in the ad-supported streaming ecosystem, we're seeing massive growth year over year, even despite the weighing of lockdowns and the pandemic. So it doesn't hold true that people just aren't streaming anymore, because the data shows us that that's absolutely not the case.
All right, well, we're going to continue to cover the story throughout the hour. Andre Swanston of TransUnion, always appreciate your insights on Netflix and the streaming business beyond. Coming up, Uber and Lyft dropping the mask. The ride-hailing giants are following the lead of U.S. airlines, saying masks no longer required. Will drivers and riders be more inclined to travel or less? We'll discuss. This is Bloomberg. No more masks on rides. Uber and Lyft now joining a growing number of major transport providers in shifting their mask policies. This after a U.S. judge overturned a federal mandate for passengers to cover their faces on Monday. Let's bring in Bloomberg's Jackie Davalos, who covers both Uber and Lyft for us. So, Jackie, I guess the big question is this going to mean drivers and riders are more or less inclined to travel?
If you are one of those that have been following mask mandates for as long as they've been around, the past 2 years, this may seem like an inconsequential update in policy, but if you're also like me who forgets their mask in a different coat pocket or purse, it might come as a relief and even, make you more likely to take another ride. for many riders, this has just been something that we've learned to live with. However, for others, it might bring them off the sidelines after, perhaps feeling strongly about not wearing masks. On the driver's side, I think that's where we're going to see more of a diverging reaction. It may not be such a slam dunk policy for driver supply because many were already skittish to come back to the platform, as we've spoken about, Emily, in the past. The driver shortage, a major reason that has really persisted is because of the heightened concern around the risk of infection by having someone in your car.
Uber and Lyft also now saying riders can ride in the front seat if they want, though of course saying that folks need to be respectful if they still want to wear masks. How much do you think this is actually going to impact Uber and Lyft's bottom lines?
When we think about where the companies are today, Uber obviously has more of a buffer with their Uber Eats business, but they've been trying to really bolster that mobility segment again. This is only going to help that. That rideshare business was already profitable, and it could only help their bottom line even further if they can boost those levels back to where they were pre-pandemic. Now, for Lyft, the stakes are much higher for them, given ride-hailing is their primary business. When we think about where some of their business comes from as it relates to airport travel, major airlines loosening their mask mandates and potentially seeing an uptick in flights is only going to help rideshare companies even more. But definitely, ridership has not totally recovered, and this could potentially put them a little bit closer to the finish line.
And what about Uberpool? On their website, Uber is hinting that it's back, but it doesn't show up on the app in the US or Europe. We actually checked this.
It's a mystery. They've been testing pool strategies here and there, but I spoke with them this morning, and the company said they have nothing to share. This is not something that's being tested broadly, but I think we will hear from Lyft in particular in the coming months, especially now that you see cities starting to revise, maybe even loosen some of their own mask updates, which just goes to show that perhaps pandemic conditions are improving more broadly, and rideshare companies are poised to benefit from that.
Okay, Bloomberg's Jackie Davalos. We'll see how this evolves. As always, thank you. Coming up, we're going to hear from FTX CEO Sam Bankman-Fried on all things crypto, from regulation to stablecoins to Elon Musk and his hints at a Twitter takeover. That's next. This is Bloomberg. FTX founder and CEO Sam Bankman-Fried, who was recently profiled in a Bloomberg Big Take on how he plans to give away his fortune, has been vocal about the Musk Twitter controversy and how blockchain could revolutionize social media. He spoke earlier with my colleagues Matt Miller and Kaylee Lyons and started by talking about crypto regulation and how it could change not only businesses like FTX, but the way traditional Wall Street operates.
One of the big things is I think that it may provide a pathway for them to get involved in digital assets. That's frankly something I'm excited about here. I think a lot of them have been waiting for clear federal oversight of the space to get involved. I think that there are really interesting applications to other asset classes. Now, you have to be careful when you do that, because you have to look at what do existing settlement cycles look like in traditional agricultural commodities. How would that interface with a system like this? I think it's an interesting question. I think it's one that needs more thought. And certainly, we would be looking to start just with doing this for digital assets. But I do think that it would be really interesting to do a deep dive, with the CFTC and crucially with the core market participants in those areas about how this could interface with that. I think when you look at things like treasuries, right? I think tokenized treasuries could be really interesting. I think it could provide transparency and real-time settlement of them, getting rid of this sort of like T0, T1, T2 system that we have for various asset classes, right? With securities where it takes 2 days to settle a trade, and there's sort of like some amount of uncertainty and risk and exposure during those 2 days. I think it would be really cool to see, real-time margining, real-time risk, and real-time settlement, based on tokens of those. So I think there are really interesting applications.
Okay, Sam, I want to pivot to another story we've been carefully following at Bloomberg for the last couple of weeks, and I know you've been following it too. Elon Musk's bid for Twitter. We just had a headline crossing from the New York Post that he's willing to invest $10 to $15 billion of his own cash for Twitter. Whether or not he eventually succeeds, you have proposed a decentralized model for Twitter. Can you just walk us through that and how you think it will be beneficial to the company?
Absolutely. I think this would be a really, really interesting and important innovation in social networks. Obviously, we'd have to see how it actually played out, but here's the core of it. Right now, one of the big problems with social media is there's lots of platforms, and all of the platforms are completely independent of each other. There's no ability to see a tweet on Facebook. If you message someone on Facebook, even WhatsApp can't read it, and that's even the same company. And so it's this, really messy system where there are, there's no interoperability between different platforms. And there's a second problem that you have here is around basically moderation, right? Like, what is the moderation policy for basically all of social media right now? It's like 3 guys, right? It's the people who run 3 companies who choose what does and doesn't get censored. And we've seen that is a broken model, right? We saw social media choose not to censor misinformation in 2016 and get absolutely roasted for that decision. And then we saw them choose to censor in 2020 and get roasted for that decision. And so here's the core of what I think would be really, really exciting, would be that you take a blockchain, you put the actual underlying messages directly on the blockchain. And what that means is that any platform, in theory, could access those same sets of messages. And so whether you're using, Facebook, Twitter, or whatever this sort of platform is, they're all drawing on all of the messages. They can all write to this blockchain. They can all read from it. What they are is different interfaces, effectively, living in this same universe. And one of the cool things that falls out of that is, first of all, you have interoperability between platforms, which solves a lot of these network problems and allows for more competition because it means new people can enter this space without being miles behind in terms of, user base growth. But the other thing that it means is that when it comes to moderation, you could have different platforms making different decisions, right? And so you could have, 2 people have 2 different platforms, but each with the same underlying set of messages accessible. And so, they don't have to deal with this network effect problem, but which makes slightly different decisions about what to censor, what not to censor. And that can at least give some consumer choice here. It can at least give people, options.
Sam, I think it's a fascinating idea, and I also had seen CZ tweet about it on the Elon Musk Twitter announcement day. I'm just wondering, have you talked to Elon about this?
No, I have not talked directly to Elon about this, but I would be excited to. I have had some conversations with people who are investigating this. I think they're really cool ideas, and I would be really excited to be potentially involved in something here. Whether you're looking at thinking, I think the biggest thing would be thinking about how blockchain could be applied here. Maybe as a test case first. I'd be excited to help on the designing and building of it, and potentially helping to manage a network that was looking to do this.
That was FTX founder and CEO Sam Bankman-Fried earlier with Matt Miller and Kaylee Lines on Bloomberg's Crypto Show. And speaking of Elon Musk and Twitter, the story has been developing day by day. Bloomberg's Ed Ludlow here with more on the latest. At Apollo now weighing a bid for Twitter as well.
Yeah, so Bloomberg sources saying Apollo is weighing a lot of options, right? Either they back Musk's bid or they back a bid from others. We know Thoma Bravo, for example, is eyeing its own bid for Twitter. One other media report suggested that Apollo could even go to Twitter and help their defense and say, let's do something together directly. And as with all deals, you get these usual caveats that the deal may not happen depending on certain circumstances. And I think you heard Kaylee allude to in that piece of tape, the New York Post was kind of the story of the day, reporting that Elon Musk is struggling to find backers for his own bid. But ultimately, he's considering putting $10 to $15 billion of his own money up front, but he'd still need to find the rest of the financing, of course, because the figure that's currently on the table is a $43 billion valuation of Twitter.
Now, one of the big takeaways here, Ed, is that investors may need to buckle up. This could be a long ride. I mean, this fight could go on for months, right?
Yeah, but we've discussed on this show, all the experts we speak to in the world of M&A say that this is playing out as a textbook scenario for a hostile takeover. There are lots of options. We think, and the New York Post did report this, that a tender offer directly to shareholders from Musk could come at some point in the next 10 days. That's great fun for me because I like to get up at 4 a.m. Eastern time in the morning and wait for regulatory filings to come through, and that's how it would be communicated. This is the thing. We have to wait and see how it plays out. But ultimately, the kind of hypothesis out there from the street is that Musk is going to have to do this in coordination with a number of parties, and that does give him options.
And tomorrow is 420, which is, as we know, one of Elon Musk's favorite days. I mean, are you going to be staying up all night, Ed, waiting for that regulatory filing?
I will stay up all day, all night, and 420 is also Tesla earnings. And when better to announce your intentions for a hostile takeover of Twitter than the earnings call of your other company? Sure.
All right, Ed Ludlow, thank you. We'll be watching. Well, Florida Governor Ron DeSantis has escalated a dispute with Disney, asking the state's legislature to consider terminating special districts where Disney currently has special privileges. For example, access to cheaper tax-exempt financing. This is the first indication that the standoff between the state and the entertainment giant over school instruction about gender identity and sexual orientation could have consequences for Disney. This as plunging shares of Netflix has impacted other companies tied to streaming like Disney, also dropping about 5% after hours. Meantime, Airbnb is not only planning to issue a lifetime ban to the guests behind a mass shooting at one of its rentals in Pittsburgh, the company is also reportedly looking to take legal action against them. This according to the Pittsburgh Post-Gazette. 2 teenagers were killed, 9 others injured at an underage party early Sunday morning. Back in 2019, Airbnb announced a global ban on all parties and events after a number of violent incidents. It also blocked thousands of rentals at the height of the pandemic due to hosts breaking party rules. Coming up, more on Netflix's first subscriber loss in a decade. I'll be joined by Lightshed's Rich Greenfield coming up. And later, it all started with crazy rich Asians. How the nonprofit Gold House is now looking to raise the profile of Asians across not just entertainment, but business and Silicon Valley. That's still to come. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Well, after a decade of meteoric growth that shook Hollywood to its core, Netflix has run into a wall. The streaming service losing 200,000 subscribers in the first quarter, the first time it has shed subscribers since 2011. Shares plummeting in late trading. Joining us now, Rich Greenfield of Lightshed Partners. No relation to the shedding of subscribers. Rich, what do you think happened here?
Look, I think what happened here is the content is not resonating the way it should. I mean, while they're making a lot of other excuses, it's hard to look past the fact that when Netflix has had great content, their subscribers have exploded. So it certainly seems like there's a connection between some of their content, especially their film content. They've put probably $5 billion into the film business, and it does not appear to be having the type of impact on subscriber growth that they expected. So they're making a lot of excuses. There's clearly, is the supply chain for TVs impacted? Is there a big problem in connected TV sales? Sure, we've seen that with Roku stock. We've seen that with Vizio. Like, we've seen this with other companies, but there is no doubt that a big chunk of this is Netflix content is simply not breaking through the way it has in prior years.
Netflix says it's going to zero in on password sharing and Shonda Rhimes to turn things around. Obviously, Bridgerton has been a hit. I'm sure you would agree. But what are they not getting right in content?
Well, remember, there's a lot of competition. I mean, they clearly called out competition, but it's not like, even if you look across Disney Plus and Peacock, it's not like there were massive competitive hits this quarter. It's not like, Hulu had the dropout, but I would not say that there were breakout hits that were really competitively pressuring Netflix. I think the big question investors are grappling with, the reason why you see the stock down so much is the question now becomes, was Reed Hastings and team just too optimistic about how big the streaming market was? I mean, we used to talk about 600, 700, 800 million ultimate subscribers. Jason Kilar, who just left Warner Media, was talking about $1 billion subscriber opportunity. If 200 million subscribers is sort of, starting to near the top, that changes everything for how every media company, legacy media company, new media company, it changes everything if that's the size of the market. And I think that's the panic you're seeing in the stock is, oh my God, is this business model far, far smaller than people expected? People were looking at multiples of where they are now for the upside, not this being increasingly a ceiling. And Emily, I think one of the big questions out there is this anyone's fault at Netflix? Like, is someone getting fired for this? Is there going to be executive shakeup because of this? Or is this really just unavoidable? And no one's at fault. I think investors are going to want to know, is someone at fault for this?
Do you think someone's at fault?
I mean, look, the content clearly hasn't resonated. I think they're going to have to explain why they feel confident in, it sounds like from the press release, it definitely sounds like they're ramping investment. They're not pulling back. You don't usually ramp investment and quote unquote double down on content if you don't believe there's a substantial long-term market opportunity. So do they believe that they're going to get to 600, 700 million subscribers still, and it's just not linear the way Wall Street wants? Because it's odd, and I think it's going to be scary to Wall Street, if they're ramping spend and they're hitting a ceiling, investors are going to panic. That's what they're doing right now.
So how much do you think the price hikes for subscribers have had to do with this? And what about an ad-supported model? Our guest Andre Swanston of TransUnion was suggesting that earlier to offset some of these costs.
Yeah, look, I know there's a lot of investors that would like them to follow suit on an ad model. Continue to not be convinced, because where an ad model is most successful is the US and developed parts of Europe, which is where Netflix actually is increasingly mature. So the real benefit to doing an ad model wouldn't be in places where there is an ad market. You could say, oh my God, hey, in India, would an advertising model help? Not really, right? The ARPU for the subscription service is pretty low, and there isn't a robust ad market for these streaming services, as companies like Disney know well with Hotstar. So I'm a little skeptical that while I think advertising could, create a short-term spike in subscribers, I don't think it's the answer. And I think it brings with it a lot of risks and what makes Netflix unique, especially when you've got companies like Amazon and Apple ad-free. So I don't think this is about advertising being the panacea. I think the question is there content? Can you make enough great content to drive subscribers to 5, 6, 7, 800 million? Is it possible, or has Reed Hastings changed his mind that the market opportunity is simply not that big? And if it isn't that big, why in the world are they not cutting back on content expense? Those are going to be the big questions for the call in half an hour.
Could gaming be the panacea, or will that just be another money pit?
Emily, what's crazy is there's really no mention of gaming at all in the press release. They actually spent considerable time in the press release last quarter, and even on their conference call last time, there's no mention really of gaming. And so the question is, gaming's obviously at a nascent stage. It's very early for them. It just started 9 months ago. So it's not as if we can say, why is gaming not working yet? Could gaming be the long-term solution? It's possible, but I don't think in the next 2 years, I doubt gaming is the catalyst for this. I think the real question is they lowered price in India. They have very little in terms of subscribers in India. Why is it not growing faster given the amount of spending they've had in India? Is it Is it just they can't seem to break through? Do they have the wrong content mix or strategy? But subscribers in the APAC region actually had slower growth year over year in Q1 this year than last year, despite lower pricing in one of their biggest markets, India. Sort of hard to understand that.
Well, it's certainly a new chapter beginning for Netflix. Lightshed's Rich Greenfield, as always, appreciate your quick analysis. Thank you very much.
The question's going to be, is it time for the hashtag good luck streaming, Emily?
All right, let's see if we can get that trending on Twitter, Rich. Thank you. Coming up, can Bitcoin truly be a hedge against inflation? We'll be joined by MicroStrategy founder and Bitcoin bull Michael Saylor to talk about inflation, Elon Musk, Jack Dorsey, and much more. He's next. This is Bloomberg. Time now for our crypto report, and the market's still looking risk averse, with Bitcoin sticking in a tight range, providing more fodder for critics who don't think it's a hedge against inflation. MicroStrategy co-founder and CEO Michael Saylor might push back on that idea, as I would expect him to. Let's bring him in now. Michael, good to have you back with us. You've been saying for a long time now you think Bitcoin is the hedge against the dangers of inflation. But what do you make of the fact that it's staying in such a tight range and not really moving on from that $40,000 mark?
Well, it's all time frame. If you go back 2 years to when MicroStrategy bought in, it's up by 400%, and it's dramatically outperformed the NASDAQ or gold or any other asset you could have bought. If you're looking at it in a matter of days or weeks or months, the traders control it. And right now, there's 3 types of investors in Bitcoin. There's the traders, there's the technocrats, and there's the maximalists. The maximalists are all in. Myself, Jack Dorsey, we think that Bitcoin is an instrument of economic empowerment. So we're just busy educating, and we sweep free cash flows into it, but we're kind of out of the market day to day. The market price is set by a tug of war between the technocrats, people that are pro-technology, and they think it's like the next big tech network like Google or Amazon for money, and the traders who are just looking at an uncorrelated asset or correlated asset. So right now, both the traders and the technocrats are kind of, scared of risk. And so they've both been in a bad mood. They've been selling. What you'll see over time is the technocrats will turn into a good mood, and they'll realize that this is the next great big tech network. The maximalists will keep sweeping cash flows.
So when does that happen? When does Bitcoin break this correlation with risk assets, if ever?
Well, I would think that over a 4-year time frame, you're better off to be a maximalist or a tech investor. But as long as there's a massively choppy market, right, uncertainty about Fed policy and fear in the near term, I think that the traders will probably dominate the price.
So you're saying we're going to have to wait 4 years for this to happen?
No, I think sometime on a day that is very unexpected, the correlation will go from 70% correlated to risk assets to 0%. And when that happens, then the traders will reverse the polarity of their trades. The technologists will start to double down. The maximalists will just enjoy the ride.
Okay, I have to ask you about Twitter with, as you say, you and Jack Dorsey among the maxis, and a huge crypto community on Twitter. You are one of the most prolific users. What do you make of Elon Musk's hint at an attempted takeover? A hostile takeover?
Well, I mean, I think there's obviously there's a lot of frustration everywhere in the world right now that's circulating about, and you see that reflected on Twitter, and this is indicative of that. It's a bit above my pay grade to determine how the entire chapter ends. It definitely makes for interesting watching.
But you're a power user. Do you want Elon Musk to own Twitter?
I think that Twitter's going to be fine regardless of what happens. I don't think I mind if a Twitter user ended up owning Twitter. I think that'd probably be a fine thing.
Have you talked to Jack about this at all? I mean, I know you've been spending a lot of time together.
No, I'm not really involved in this. This is not really my area of expertise. I think I'll let people that are focused upon tech stock investing decide the fate of Twitter.
What about
I'm focused on Bitcoin. Go Bitcoin.
Yes, indeed. But of course, there's a huge crypto community on Twitter, and I'm curious what you think the impact could be on the crypto community, whether or not you think, for example, Twitter should be decentralized.
I don't think that Twitter is going to be decentralized regardless of the outcome of all these discussions right now. I think Twitter is a centralized service. I think that the only thing we're sure we can decentralize is Bitcoin, which has been very successful, but it's a much simpler idea. I think they were trying to decentralize highly functional, high-speed applications. That's very challenging, and no one's really successfully done that well yet.
You seem really optimistic about Treasury Secretary Janet Yellen's understanding of Bitcoin. And I'm curious, even though we might be looking at a longer time frame for the divorce of Bitcoin and risk assets, do you think we're at an inflection point when it comes to regulation and mainstream adoption?
Yeah, absolutely. I think April 7th at American University was a really critical speech. I think it's probably one of the most important speeches of the century, because you had a set of deniers, people that said that Bitcoin is a mirage or a Ponzi scheme. And then you had a set of skeptics that said, well, it isn't that, but it's too good to be true. And so some government's going to take it away from you. And when you have the Secretary of the Treasury giving a speech explaining what decentralized networks are and what digital property is and what Satoshi Nakamoto means to the world, I think it clicks in a lot of people's mind that Bitcoin is actually technology that's revolutionary. And it also clicks that, no, it's not getting banned. And once you decide it's real technology to improve the world and it's not being banned, you're no longer a denier and you can't be a skeptic. So you have to move into the trader camp or the technocrat camp. And eventually everybody ends up as a maximalist if you understand it well enough.
So there's a long answer to my next question, but give me the nutshell answer. With the Ethereum merge coming up, what changes? What are you predicting or expecting?
Yeah, well, they keep pushing it back, but I mean, I think there's huge questions about what Ethereum is following that merge and whether it's a security or whether it's property. And I think a lot of people have implied that staking networks are digital securities, not property. So I just think they're moving into a very uncertain chapter of their existence.
All right, Michael Saylor of MicroStrategy, always great to have you here on the show. Thanks so much for stopping by. Coming up, we're going to get back to Netflix, that huge subscriber loss, the first in a decade. That's next. This is Bloomberg. The debut of Crazy Rich Asians back in 2018 was a huge cultural moment. It helped to usher in more films featuring largely Asian casts, including Parasite, which won the Oscar for Best Picture, and the critically acclaimed Everything Everywhere All at Once, out now. Gold House, a nonprofit that was founded to capitalize on the momentum of Crazy Rich Asians, is focused on reshaping public opinion about the Asian and Pacific Islander community. Now, they're launching a new accelerator class along with a $30 million fund called Gold House Ventures to take this momentum to Silicon Valley. Joining me now, Eric Fang, general partner at Gold House Ventures. Eric, great to have you with us. So tell us the short origin story of Gold House and how that evolved to Gold House Ventures.
Well, Asians have long lacked a voice in America and a unifying organization to bring our wide diaspora together. And the team here at Gold House thought that that was a huge opportunity. So in 2016, we launched what has turned out to be the premier collective for Asian thought leaders, creators, influencers, and business leaders to band together and promote really three things: unity, success, and representation for our culture.
In Silicon Valley in particular, what kind of challenges and stereotypes do you think Asian founders face when they're pitching, when they're trying to raise money?
Yeah, it's a great question. Well, you know, in the technology field, and that's my background. I'm an engineer by trade. Well, our representation is incredibly strong. We're about 30% of the overall tech workforce. But if you look at C-suites, we are in the single digits. So I think Asians have been given a lot of opportunity to participate in tech, but not participate at the highest levels. And then when you factor in, not all Asians are the same. You know, we're a very, very wide, diverse culture. So you have East Asians like myself that I think have been afforded lots of fantastic opportunities, but there are women that have been marginalized, Southeast Asians that suffer a lot of systemic racism and bias against them. And for us as a community, we really need to do better to lift each other up. And that's why Gold House is so important as a way to bring everyone together, not just East Asians, not just men, but women, Southeast Asians, people from Indonesia, Cambodia, Vietnam, across the entire community. That is really our focus.
You've brought in some big name backers and mentors like Tony Xu of DoorDash, Binance CEO Changpeng Zhao, Steve Chen, who helped found YouTube. What are they bringing to the table, and how are they helping your current class of founders?
Well, the number one thing that they do for us is they serve as a example of great representation that can inspire the next generation of leaders. Steve and Tony and CZ, incredibly brilliant, successful entrepreneurs, but also reserved, also very quiet, humble, and we want to be the megaphone that they may not want to be, because it's so important for us to showcase that our people, our community can achieve those levels of success, shatter those bamboo ceilings, break out, and really inspire others. So that's what they bring. Their success is what we can hopefully build the next generation of great Asian leaders on top of.
You're competing with traditional venture capital funds. How will you measure success?
Well, that's a really interesting model that we've decided to set up here at Gold House Ventures. So first and foremost, we are a for-profit initiative. We have great LPs like Tony, like Steve, like CZ, that we want to help deliver a great rate of return on their capital. We consider it an honor and privilege that they've chosen to give us their capital. And it is our responsibility to show great returns on that capital. So for them, it is very much a for-profit initiative. But for the Gold House Collective, for the general partners like myself and my partners Megan and Bing Chen, for us, it is a nonprofit initiative. So all of our fees and carry actually go back to the nonprofit. So this dual goal, this dual strategy, I think is very unique to the Valley. And as I like to tell our LPs, we want to make them a lot of money, but we want them to feel good about it in the same time. And what that's really opened up the doors for is tremendous support from the community. We have a great, not only network of LPs, but we've got investors from top firms like NEA and Upfront Ventures and Excel and General Catalyst that want to help us out. They're mission-oriented in line with us. So I think the really unique thing, too, that we're doing here is that we're very much making venture a team sport. You know, historically, it's been this kind of individual sport, highly competitive, but with Gold House Ventures, it is a team sport. We are all working together to really try to improve the future for our community.
Quickly, Eric, before you go, I got to ask you about Netflix. You spent a long time as an executive at Hulu. You know the streaming business. How bad is this? The fact that we're seeing the first loss of subscribers in a decade. Has the streaming business plateaued?
You know, I think what this is a reminder is how humbling it is that in the 100-year history of entertainment, it is still a hits-driven business, and no one can manufacture hits. We've seen a lot of folks and a lot of different companies try, like Zynga in the gaming space and Netflix in the video space. And no matter how much technology and science and engineering and data that you apply to it, it's still up to the gods of entertainment to shine good fortune on you. And I think that's what's reflected in here. It's not so much the competition and, you know, the account sharing. I think it's mostly that where's the next Squid Game? Where's the next Bridgerton? Where's the next big hit? And that's what all entertainment companies are still at the whims of.
In the hands of the gods, apparently. Eric Feng, Gold House Ventures. Eric, great to have you back on the show. Thank you. I want to get back to that story of the day. Netflix, Ed Ludlow back. We're waiting for that earnings call to begin. Ed, what are investors going to be digging into?
Yeah, 100 million people and households have Netflix but don't pay for it. Where are they? How do they get around that? As we just heard from Eric, content is king. What does the pipeline look like? 200,000 customers lost in the first quarter, forecast of 2 million lost in the second quarter. Where are they being lost? Which markets are having pain? Those are the big questions.
All right, Ed Ludlow, waiting for that Netflix earnings call to begin. Again, losing 200,000 subscribers, the first time Netflix has lost subscribers in a decade. The company saying 2 million more to come in the coming quarter. We'll be listening into that call. That does it for this edition to Bloomberg Technology. Join us tomorrow. We're going to be breaking down Tesla results. Steve Wesley, one of the original Tesla board members, will be joining us. And make sure to tune in for my exclusive conversation with AWS CEO Adam Selipsky. That conversation happening tomorrow, 3:30 Eastern, 12:30 Pacific, right here on Bloomberg Television. And check out the podcast, as always, anywhere you get your podcasts. I'm Emily Chang in San Francisco. This is Bloomberg.